The market is optimistic that a debt ceiling deal will be passed, but how do we feel about it? Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our weekly market recap webinar. My name is Chris. I'm part of Riz International, and we are a group of traders who are trying to make our money work for us and not the other way around. And if you are watching this replay on YouTube, I'd ask if you just take a second, click that like and subscribe button, click the bell notification icon right next to it to make sure that you get alerted every time we upload more content here on the channel. It would be greatly appreciated. So we're going to start taking a look here at the S&P 500, and for about the last month and a half, it feels like the market has been doing nothing but traveling sideways. We've been stuck between this 4,100 and 4,200 area. Sure, we've breached down below and we've pushed up above it a couple times, but we hadn't had any really serious movement until Friday. Now, we had a lot of hype going into Friday with the debt ceiling deal supposedly being taken care of, and there's a lot of euphoria in the market at this point, and plus anybody who mentions AI or anything along that nature seems to decide that it wants to go to the moon. Now, of course, retail is also pumping right now, and institutions are pretty much FOMOing at this point. Riz has been keeping an eye on this, and institutional money is really having the fear of missing out, and they are jumping in now and trying to ride this up. Now, that does not mean that's what we are doing. Currently, we are being much more conservative in our game plan because we feel that this is overdone. You do need to remember that there is about a 70% chance that the Fed will raise interest rates another 25 basis points at their next meeting this month. So with that in mind, the market is actually pricing in now that there will be a rate pause. Here at Riz International, we are not on that bandwagon. I will tell you right now, we expect more interest rates this year and really feel that if the Fed decides to pause now, it would be a huge mistake. Now, the Fed may see things differently than we do. Obviously, we don't have an insider there or anything like that, but we feel at this point this run-up is not deserved. It is really just a lot of euphoria about the debt ceiling being done. Everybody thinks everything's great, green skies, green pastures, all that, blue skies, I suppose, but green if you're looking for money. And everybody is just jumping in thinking that this is it, we've got everything taken care of. And the truth is the debt ceiling deal really does a lot for people, we'll just say who have, and for the rest of us, maybe it's not such a good thing based on what they did. So our feelings about it thus far, I should say, are not positive on the debt ceiling deal. However, the market is reacting in a positive way, and we can't ignore that. But we would say be careful trying to chase this rally. Of course, we never advocate chasing a move like this because the move's already been made. But if the Fed decides to raise interest rates later this month, we do expect there to be a bit of a retracement from this move. However, we could have a full retracement on Monday if, there's not a lot of positive talk about the debt ceiling being passed, or that the Fed is rather hawkish on interest rates. So we're going to be keeping an eye on that. But let's take a look at what's breaking down the S&P 500. And one thing I want to draw your attention to are these three sectors that are just ridiculously outperforming the market at this point. And that would be consumer discretionaries, communications, and tech. Now, of course, there's some overlap in tech and communications, but look at this. Tech has been on an absolute tear ever since the NVIDIA earnings and their talk of anything related to AI. And we really feel that this NVIDIA move is a bit overdone. Let's take a look at it here. I can show you what I'm talking about. Just this massive run up post earnings, and of course, they are, let's give credit where credit is due. They are probably on the forefront of, GPU technology and all of this stuff regarding to AI right next to TSM. But, we feel that this is a bit overdone. This is not really, a fair move based on what the earnings results were. Yes, they did beat fairly handedly, but still seems a bit overdone in our opinion. But if you look at other chip manufacturers as well, primarily AMD, we're getting a sympathy move from there. And basically anything related to tech at this point is just going and going. Let's take a look at the big one, Apple, of course, on an absolute bull run right now, and we're seeing that reflected here in the tech sector being up over 35% on the year so far, with the S&P 500 only up 11%. Now, if you look at these and think about it, these three sectors are currently what is holding up the market. So what happens if someone pulls the bottom out from one of those? Well, I think you could probably guess that the market's going to do something like that. And that is what we are being very cautious of at this point, because these are very, very high for what they've accomplished this year. And of course, there's all this talk about AI right now and things like that. If they put a moratorium on that, or they, slow the production or development of AI, that could obviously negatively impact these sectors. And everything else you'll notice is below the zero line at this point. We've got real estate, we've got consumer staples, healthcare, financials, energies, utilities. Everything is on below the zero line. Now, I will say that they are perking up with the market running over the last 2 days, but still, if the bottom falls out on one or two of these, we should see a fairly decent sized retracement, because these three sectors are currently propping up the market. Let's take a look here at the asset classes, and there's really not too much to discuss when it comes to oil. Oil is really trading sideways at this point, just hanging out here right around, let's see, we closed on Friday at 71.74 per barrel for light crude, and we really have not seen the summer run up just yet on oil. Now, gold has been interesting, ever since the Silicon Valley crash, which happened around here. Gold had been on an absolute bull run, just going nuts, came incredibly close to touching the all-time high for gold, but we did not make it, and we rejected pretty hard off of this 2050 level, and we are currently below the 2000 area that had been holding as support for a couple days, for about a month, I would say, but then we have pushed down below it, and we are now back inside the channel that we had been in for gold for quite some time, between this 1967 and 1679 area. Though that has been fairly solid for gold over the last few years, and with, of course, exceptions. We have, some breaches here and there, but typically it gets back in that channel, and that's where it hangs out at. But we have no trade on gold right now, and it's definitely looking a little bearish. Gold really kind of selling off pretty hard here ever since we got close to that all-time high on the 4th of May. Let's take a look here at the bond yields for the last couple weeks, because we had a long weekend with Memorial Day, and we have been pushing very hard on the interest rates. Have been making a very nice move up, and you see that correlating with the strength of the dollar. Strength in the dollar is returning after a lot of the fear of the potential default on the United States debt. With a debt ceiling deal not in place, we are seeing a lot of strength coming in for the dollar this week, actually here since about the 11th of last month. So, really pushing up nicely here, and the interest rates are following along with it. So everyone who says the dollar is dying, sure doesn't look like it to me. Just remember that this is the US dollar index. It's compared to all other currencies in this index, so it gives us an idea of the relative strength of the dollar compared to other currencies. So right now, dollar looking pretty solid. Interest rates are starting to scoot back up, with the 2-year leading the way, currently at 4.5% for those 2-year government bonds. Now I want to take a look here at the key dates in the market this week, and there are none. I'll just tell you that right now. These should not have any significant impact on the S&P 500 this week. We're not really seeing any major catalysts. We're kind of waiting for the Fed decision to come out here in a few weeks. That's really going to be the big catalyst that everyone is holding their breath about. Now, I did have a couple questions get sent to me via our members on Riz in our channel, and I want to go over those tickers right here. The first one being Target, and the question was, has Target found a floor around this 130 area? Now, there are several different factors driving this huge sell-off, and of course, pretty much, let's just say a poor choice in marketing was made by Target, and that has received a lot of negative press, and the stock price has plummeted, as well it freaking should. Now, from the standpoint of a father and someone who doesn't necessarily care with the messaging and branding that Target is using, I would not take this long. Now, that's just me personally, and I'm not giving financial advice, just my recommendations personally. However, from a pure technical standpoint, we see that this 130 level has been a rather solid inflection point in the past. Back here, looks like in about 2019. So we haven't been that low in quite some time, but it definitely bounced pretty hard off of that 130 area. So from a technical standpoint, I think that you could potentially play the recovery a little bit here. I would be careful as we do have some overhead resistance right around 139. But yeah, from a philosophical standpoint, I'm not touching this. I don't care how juicy the bounce looks. I don't care. I don't want to support this company anymore. However, if you are trading dispassionately and don't care about such things, this could be a decent spot for Target to potentially rebound from bouncing off this support at 130. The second question came about IEP and what is going on with that. So this is a Chinese garbage stock. Let's just call a spade a shovel, shall we? So we had this huge sell-off in IEP. Earnings were pretty bad from what I'm seeing. Yeah, massive miss on earnings here. And we seem to have found a floor around 18. We had a really hard rejection of 18, pushed all the way down there on the 23rd and have rebounded off of it. And we are looking up at this point. So, again, from a technical standpoint, this is starting to look like it's wanting to perk up. But that being said, this is an incredibly volatile ticker and not one that I would take long very lightly, nor would I go in full position size on something like this. This is a much more speculative play, and even though we are slightly trending upwards here, it really doesn't give me a lot of confidence that, again, we kind of came here off of this 24 area and rejected fairly hard off of it on Thursday. Furthermore, the S&P 500 was pumping pretty hard on Thursday and Friday, and this thing traded down on Thursday and basically sideways on Friday. So not very confidence inspiring. You could try and play this uptrend, that we're seeing, but honestly, it's really not an uptrend because this was just support from where we were before, and as you can see, we broke through that pretty hard. So I'm not touching this with a 10-foot pole myself. I know that our member had requested, if I thought that we'd found a floor for it. It appears as though 18 is pretty hard support for this ticker, but me personally, I wouldn't take it. But again, that's just me personally, and I don't want to necessarily tell you what to do with your money if you would like to go ahead and take a speculative play on IEP long. That is going to do it for our market recap. I know that this is a bit shorter than usual. However, on our actual recording, I had a party going on in the background because our daughter had been baptized on Saturday, and so we were having a bit of a party, and the background noise was way too loud. I didn't want to subject you to that, so I decided to go ahead and re-record this video real quick so that I could give you nice, clean audio and that it was a bit more enjoyable. So this week in the market, obviously, we are going to be making sure that the debt ceiling deal actually goes through. That's kind of the big catalyst this week. There are no real economic catalysts to speak of other than the debt ceiling deal and anything going on, of course, in the world that could potentially move the market one direction or another. So there's a lot of different things right now that are happening around the world that could impact the market in different ways. Of course, all of the tension right now surrounding Eastern Europe, things happening in the Balkans, the South China Sea, the Taiwan Straits, all of these things can play a role in the market no matter what happens to the debt ceiling deal. That will be insignificant if we see escalation of conflicts in these areas. So we need to be keeping a watchful eye on things that are happening around the world, not just here in our backyard in North America, and be aware of these things because these types of catalysts will blow out any type of hype or happiness surrounding a debt ceiling bill that gets passed. I can promise you that. So those are things that we're going to be watching this week in the market. I want to thank all of you for coming, and I appreciate your understanding with the re-recording. I hope that it was a bit cleaner for you. Our Riz Elite members had to suffer through the party last night, but it was not in vain. I enjoyed having all of our Elite members, and if you are not on the wait list to join Elite later this year when we reopen up membership, I highly recommend you get on that wait list. The link is down in the description of this video. Again, please make sure to like, comment, and subscribe, and we'll see you in the market on Monday.